Well, everyone, thank you for joining us at the end of your workday. We're excited to talk about where the veterinary market is going, what we've seen over the last couple of quarters, and answer some questions from you, whether that's at the end of this webinar or later on. Rich will put his calendar link in the chat so that if you have follow-up questions for him, you can schedule time. But just as a reminder, we cannot hear you. So if you do have questions, there's a Q&A box on the screen, so you can type your questions in there. If we don't get to them during the webinar, during the slides we're walking through, we'll get to them towards the end. And then Rich will put a link to his calendar in the chat box as well. So if you wanted to discuss anything one-on-one about the industry or your clinic, you can definitely do that as well.
Actually, hopefully Liz will put my Calendly link in because I'm not that capable while I'm talking.
We will
Go
get it
ahead.
done. And so before I get to our team and to Rich's background, wanted to start a little bit about who Ackerman Group is. So since the company was founded almost 10 years ago, we've sold over $2 billion of headline value in clinic sales. That's almost 300 clinics over the last 4 years alone. And when you average that out, we're selling on average about a clinic a week. That means when you look across the vet industry, we have access to the most data on who's buying, what those multiples are, the terms they're offering for sellers. It gives us a really comprehensive view across hundreds and hundreds, if not thousands, of offers a year on what's happening in the industry. Also, for the clients we're working with, the sellers of vet clinics are the people who we're doing free profitability analyses for. We're understanding what are market trends. Are invoices going up or down? Are prices going up more or less than they used to? Really big access to market data that's pretty proprietary and not a lot of other people have access to. And so who's our team? So we have client-facing people like myself and Rich and a few others. So we're interacting with buyers and the owners of vet clinics every day. We have a couple people on our finance team who crunch the numbers, whether, again, that's for a free practice valuation and profitability analysis or preparing the clinic for sale. We have people who help collect some of that data I was just referring to on the last slide to help with due diligence during a sale or to do some of those financial analyses. And then we have marketing people to drum up interest both for our clients, but also to make sure that prospective buyers are interested in working with us. We've also recently expanded into Canada with Michael Kemp. So that's a really exciting expansion and going really well over the last year. And so I'll touch on Rich's background a tiny bit, but I'll leave the rest for him to explain. He has almost 20 years of vet industry experience, with most recently leading one of the more successful corporate buyers in the marketplace, Veterinary Practice Partners, for about 10 years before taking over as CEO of Ackerman Group. And again, I don't want to speak too much for his background, so Rich, I'm going to hand it off to you from here.
Thanks, Ryan. I appreciate it. And I want to thank everyone for spending their Tuesday night with us. Hopefully over the next 40 minutes or so, I'll provide a bunch of information that's useful. As Ryan said, my background, I worked and led one of the consolidators for about 10 years and have been co-CEO, now CEO of Ackerman Group for 4+ years. So I have a unique perspective on the industry, having been a buyer of clinics for a number of years and now helping individual veterinarians sell their practices to my old company and 30+ others just like it. So that's my background. What are we going to talk about tonight? So there's just a lot of things going on in the world and in this country. So from a macroeconomic standpoint, I'm going to spend a little bit of time on tariffs, the one big beautiful bill that was recently passed by the Trump administration and what that means, as well as inflation. And so those are sort of some of the big macro things that will ultimately impact and are impacting the veterinary services market. And we'll talk about trends in the vet market, both at a macro level in terms of revenue and invoice growth, as well as what's happening in the practice acquisition market. And then I'll touch on some deal structure stuff, and then I'll open it up to questions towards the end. So tariffs, inflation, and the economy, and the one big beautiful bill. What's happening? So there's a lot. I guess what I would say is over the last 6 to 7 months, the way our government operates has been transformed. And that is something that during the election, President Trump talked about regularly, that he wanted to drain the swamp, change how things are done. And he's been executing on that over the last 6 months. And one of his big areas that impacts the economy has been tariff policies. And so back in August, he sort of back in, not in August, back in April, he raised tariffs pretty radically for a few days and then pulled those back and put sort of a 90-day waiting period to negotiate new trade deals. And a whole bunch of new trade deals have been put in place with the UK, the EU, Japan, and Korea. There's still some open stuff with Canada and Mexico, but know that with Canada and Mexico, the successor to NAFTA covers most of the import-export between the three countries in North America. But there's still some small items that are being subjected to tariffs, and it feels like President Trump is angry at Canada, so we'll see how that impacts. But at a high level, it feels like the stock market now has sort of stopped reacting violently or with big up and down swings to tariff news, because it's assuming that Trump is going to be aggressive with countries. He's going to upend how things are done, but ultimately he'll get to somewhat rational deals. And I think the lesson of what we've seen is tariffs will go up. They will go up in a material, but not a crazy high way. And the stock market's assuming that businesses will adjust. The key thing is that it's unclear how these tariffs are going to impact inflation, which really is how much will pricing go up. And I'll show a slide in a minute that shows a trend that's imperfect right now. The other big event over the last couple of months was the passage of the One Big Beautiful Bill that really has helped the stock market. And the reason it's helped the stock market is there's a lot of tax breaks and tax policy that has been made that was going to be set to expire at year end that's now been made permanent. And there have been tax reductions that are going to drive spending by consumers and help drive the economy. And on the flip side, the stuff that most people are not happy about, cuts in Medicaid, cuts to food stamps and other programs, all of that stuff has been delayed until after the 2026 elections. So there is no sort of cost savings side on that front. There's just tax breaks to consumers and to all of us in the short term. And so the stock market's reacted relatively positively to this bill. The bond market, though, has also reacted, meaning there's a view that the U.S., our deficit will rise, and that we're spending way too much and way more than we're collecting in taxes. And so long-term interest rates have moved up a little bit, and do not seem to be moving down. And so that does impact interest rates, impact valuation of veterinary practices. It impacts valuations of all businesses that are going to be purchased with some debt. And I'll get into that detail in a few minutes. At the end of the day, I feel like businesses crave consistency in government policy, and they want predictability so they can make investment decisions. But it does feel like, I like to call it a new normal, where the uncertainty that the new administration has created by upending a lot of common practices that have been predictable from the government, his upending of those policies has settled in, and the markets are not reacting the way they were earlier in the administration. And hopefully that new normal will help businesses make decisions. So how are tariffs and the One Big Beautiful Bill actually impacting the economy? Well, couple of important things. Interest rates, which are the light blue line, have been kept flat for now 9+ months. The Federal Reserve has interest rates, short-term interest rates, set around 4.25. President Trump has been pushing Jerome Powell and the Fed to lower rates. They have resisted, and they've resisted because there's all this uncertainty around inflation, which is driven by tariffs. And through May, the impact of the tariffs weren't really showing up in the inflation data. We had 3% inflation when Trump took office in January. It went down to 2.4% in May, but in June, it went up to 2.7%. So that move has created more uncertainty for the Fed, which is leading them to keep interest rates flat. Veterinary practice owners and consolidators are hoping interest rates will go down so that the cost of borrowing money to buy practices will go down. Hasn't happened yet, and will it happen? Unclear. And the other big thing that happened over the last few days is the labor market clearly has softened, according to Department of Labor statistics that were released late last week. Those statistics did not make President Trump happy, so he fired the person in charge of that department in the Labor Department. And so it'll be interesting to see how that person is replaced and how that impacts the data that we see. But a softening labor market is not a great sign for the economy. It may, when the economy is softening, you'd usually see interest rates coming down, but inflation's going up, not down, with a softening of the economy because of the tariffs. So it's creating some really complicated economic policy decisions. What's happening with the overall economy is measured by gross domestic product. And as you can see, in the first quarter of this year, GDP was down a bit, and that was primarily driven by anticipation of tariffs. Businesses bought lots of stuff and built up inventory. And then in the second quarter, you can see GDP was actually great. It was up 3%. And that's primarily driven by people not buying goods because of the tariffs, and inventory is going way down. And so it's really unclear where the economy is because the tariffs are having big impacts on the GDP stats and how they're calculated. So final point on sort of Trump and sort of this new normal. I like to always say that, like, whether you like him or hate him, what he's actually doing is executing on exactly what he said during his campaign. He wanted to really change how Washington worked, try to create a new normal, try to root out sort of whatever the deep state. And he has done a lot of the things that he's talked about. One of the things that's been really hard for the market and for the Democrats to handle is the level of activity has been unbelievably rapid with, aggressive immigration enforcement, with tariffs moving up and down, DOGE sort of leading to a lot of shrinking of the government. And it'll be interesting over the next number of months to see how that impacts services that we as citizens receive. And then outside of our country, we've got still the war in Ukraine. We've got issues in Israel, Gaza, and Iran. And so there's just a lot going on, which makes things from an economic standpoint sort of hard to predict. And how this all impacts the veterinary industry has been surprising in that it has had very little impact on the acquisition market. But we'll talk a little bit about how it's impacted the market overall. And if you watch these webinars or read our quarterly reports, we've been saying that the market's at an inflection point now for probably 9 months. And so the question is it really at an inflection point? And I'm starting to become a little uncertain about that, and I'll sort of explain why. So this chart is something that we update every quarter. And to be frank, it's one of the, having been in this industry since 2008, so I'm 18 years into the industry, it's been a really challenging last 3.5 years for the industry. when you think about the 2010s in the veterinary industry, it was one of the most predictable, stable businesses where invoices grew a half to 2% every year, revenues grew 5 to 6% every year. And during the 2010s, our economy was growing around 2 to 2.5% a year. And so the veterinary industry, where revenues were growing 5%, but the economy was growing 2, 2.5, our industry was growing at twice the rate of the economy. And that led to tons of investment capital coming into the industry. So when I started my old business back in 2010, 11, we were paying 5 and 6 times EBITDA or profit for clinics. And over time during the 2010s, that 5 to 6 became 7 to 8, became 8 to 9, became 10, 10 plus. And that's because more and more consolidators or buyers came into the market. And with that stable growth that was at twice the rate of the economy, there was a predictability to growing revenue. Then COVID hit in 2020, and there was a short-term drop in visits with the original COVID lockdown. But then late 20 and 21, our industry took off like no other. And invoices grew 5, 7, 10% some quarters, as you can see in the graph. Invoice growth is this orange graph. But when you have such rapid growth, we also had a lot of price increases. People took a lot of price. And now the hangover from that is since the beginning of 2022, every quarter, now 14 in a row, we've seen invoice declines. And those invoice declines mean that the industry is actually shrinking except for pricing and people taking price. And the thing that was most disappointing in the last couple of days was when IDEX released data on invoice growth, it was actually negative 3.6% for the second quarter of 2025, which is probably the lowest or the second lowest that it's been over this 14-month period. So, when I talk about all this uncertainty in the economy, it has impacted consumer confidence, and we're seeing it in fewer vet visits. I also think the industry, when it took a lot of price and raised price significantly in the 2021, early 22 timeframe, there has been some backlash and the invoice growth has slowed. And so to tie this back to the beginning of what I said when I turned to this slide, there was a ton of investment capital that came into the industry in the 2010s because of the steady, predictable growth. When you had COVID and you had this rapid growth, you knew that there'd be a period of time where growth would slow because it wasn't sustainable. But 14 quarters of negative growth is concerning. Private equity firms and investors still seem confident in the industry. They're still buying clinics at rapid paces and at good pricing. But my question for folks when I think about this is, will that last? And if invoices continue to slide, will pricing in the industry and pricing for individual clinics go down? I don't know the answer. If I had the crystal ball, it'd be easy. It's why I keep talking about an inflection point. Will this negative invoice growth at some point impact the valuations of practices? And what this slide says is, to date through June of this year, we haven't seen really any impact. Actually, valuations, which peaked in 21, came down steeply in 22 and 23, and now they're inching back up. And so, as Ryan said at the beginning of the presentation, we have the largest database of deal activity in the industry because we're doing more transactions than anybody else. And we see that in the first half of this year, the average general practice weighted average sold for 12.5 times EBITDA. Stuff was as low as 8 or 9, as high as 14.5 or 15. But a weighted average of 12.5 is a really attractive multiple, especially in the face of industry headwinds where invoices are declining. And so we've been really excited by what we're seeing in the market. We've been seeing a lot of interest from buyers. What we started saying in sort of end of last year is, with this negative invoice trend, if you're going to sell in the next 2.5 years, you should probably do it now because we're concerned that valuations may be challenging if the invoice declines continue. So far, we've been crying wolf a little bit, and valuations continue to go up and be strong, but invoice growth hasn't returned yet to the industry. So why are valuations strong? So that we see it as two things happening. One is that there's a lot of diversity in buyers. It's not two or three large buyers driving the market. So this slide is a bit of an eye tease, but in each of these bars, this represents the transactions or hospitals that we've sold, and each color within a bar represents a different buyer. So in 2025, where we sold 29 hospitals so far in the US, one in Canada, we've worked with 13 different buyers. And we've worked with small and mid-size and large buyers. And what that tells us is that there's a lot of interest and there's a lot of different groups that are active and buying. And so if you're going to sell your practice, like you may not know all 13 of those buyers. And by the way, you see that the colors sort of change year to year in this chart. And that's because who's active and who's buying a lot changes year to year. So the good news is there's still a lot of activity, there's still a lot of interested parties, and hopefully that will continue for a long time. The other thing that's been interesting for us to note is that the quality of the quote quality, meaning defined as size of practice, has been going up this year. And so this first chart on the left talks about the average purchase price that we've received. And in 21, there was a peak at north of $10 million per hospital. This year, we're back to north of 8 million, and pricing has gone up, as you can see, from last year. And the other piece that's interesting is the second chart on the right is the average EBITDA of the deals that we're doing. And so we're actually this year back to similar levels to 2021, where the average deal is about $835,000 of EBITDA. The average price is a little bit lower, so the average multiple is a little bit lower than 21, but it's materially higher than 23 and 24. And so larger practices are coming to market, and the appetite for those larger practices is, insatiable, is basically the only way to describe it. So the diversity and quality of the diversity of buyers, the quality of sellers is helping drive the market and can keep it high. The other thing that's driving the market has been the lack of a recap market, and I'll explain what a recap market is, and the desire for lots of the consolidators to build momentum so that they can actually execute on a recap. So a recap is when one of the consolidators actually sells from one investor to another. And so in December 2024, SVP and NVP, which had the same investor, merged together and took in new money from a group called Silver Lake Capital. So Silver Lake invested a whole bunch of money into the merged SVP MVP business. And they did that at around a 17 or 18 times EBITDA valuation, which was, by most standards, is really attractive compared to what we saw in 2021, 22. In the vet industry, it was a little bit lower. Those deals were done at 20, 21, 22 times EBITDA, but still a robust valuation. There are 10, 15, 20 other consolidators out there that are thinking about doing recapitalizations when the timing is right. What's been disappointing is no other recaps have actually happened since the SVP MVP merger. We're pretty confident that there are people in market trying to do these, but PE firms have been a little bit reluctant given the uncertainty with tariffs in the economy. Lenders have been uncertain as well. But the real question is, at what valuations will these recaps be done and when? But the fact that they're not happening has also encouraged the buyers and these individual companies to keep acquiring because they want to show momentum and show that they're growing their businesses as they potentially go to recap. And so this recap market's complicated, but it does positively impact the individual hospital market, especially as people are thinking about doing recaps. They want to build momentum for them. Hopefully, that's not too confusing. And finally, when you think about all this, like the only way I can describe the veterinary market is that it's been really resilient. And by resilient, I mean valuations are remaining really, really strong in the face of sort of uncertain both economic macro conditions as well as really uncertain conditions in the veterinary market where, invoice growth is just hasn't been there. And so we are seeing deals done 8 to 14, 8 to 15 times EBITDA. We're seeing practices over $500,000 of EBITDA having lots of interest. And smaller hospitals, there's still plenty of interest. The question is, will pricing continue to go up? Will it go down? I have no idea. I would have thought by now that we would have seen a plateauing in valuation, and we haven't. I know some sellers are waiting for interest rates to decline. That may happen. Will that raise pricing? It could. The demand from the buyers is really important, and we're seeing a lot of that. But that's all counteracted by the invoice decline, which I've harped on a little too much. So overall, our market's been resilient. It is still strong. How long that lasts and how long the, 8 to 15 times EBITDA remains, time will tell. So what's going on with deal structures? I got 2 or 3 slides on that, and then we'll open it up to some questions. So the market has adjusted to, rates had been 5%. They went down to 5 plus. They're now at 4.25. They've been stable for a number of months now. In 2000, what we've seen is back in the 2010s, a lot of deals were done with mostly all cash. As valuations rose, there was more and more structure put into deals, and structure is basically anything that's not cash paid at close. And the type of structure that gets put into deals is what we call top co-equity or equity in the parent company. It could be a joint venture at the hospital level. It could be contingent notes and earnouts. And so there's been an ebb and flow of how much structure goes into deals. We'll show you a graph in a minute, but in 2024, the amount of cash actually went up nicely. And that was partially because interest rates declined during 2024. Rates have sort of stalled and plateaued the last 6 to 9 months. And so the upfront cash has been declining a bit. And so I'll show you some data on that. Other market trends, doctor retention is still crucial to every deal. Associate doctors who are producing a lot of revenue are going to be asked to sign long-term agreements with non-competes. And in almost all cases, we're seeing them being provided with retention incentives so that they are committed and have incentive to stay. What we tell doctors who are producing real revenue that are looking to sell is that you should start your sale process at least 3.5 years before you want the optionality to retire. And we say 3.5 years because producing sellers are always asked to stay 3 years. It takes 6 or 7 months to actually go through the sale process and close and start that 3-year clock ticking. And so if you're 65 and you haven't started a sale process and you want to retire at 66, you're either going to sell at a tremendous discount or have to delay your retirement. So really think through when you want that optionality so that you can time when you start your sale process. Other market trends that we're seeing, I mentioned it a minute ago, there's insatiable demand for the best practices, sort of 40 AVMs, $500,000 or more of EBITDA, especially in good markets. Demand for sort of 2 to 3 doctor practices remains good. It's very market specific. We've sold 3 doctor practices in Charlotte and Atlanta and in Dallas, and there's lots of interest because those are really good markets. It's a bit more challenging if you're in Des Moines, Iowa, or in Billings, Montana. Like geography and quality of building and opportunity really do matter, especially on the smaller clinics. So keep that in mind, depending on where you're located, and how big your practice is. This is the slide I was going to talk about on cash is no longer king. So last year, 81% of the deals that Ackerman Group did, this blue bar here that hopefully you can see my cursor, had at least 70% cash paid at closing. This year, that's down to about 50%, still well above the 22 and 23 figures, but we're seeing less cash. And part of that is who the buyers have been that we're working with. Part of that is that interest rates stalled and didn't continue to climb and continue to decline. And part of that's people just being more conservative. And so when we're working with sellers, what their goals are, how much cash do they want, need for retirement, all goes into the discussions as we talk about who might be the right buyers and the right partners for a given practice, because cash is really important as part of a deal. So summarizing everything I've said, hopefully I haven't confused you all too much. The economy is in flux. Interest rates have been actually stable despite President Trump's pressures. Tariffs are just a big overhang on everything. And as importantly, tariffs impact on pricing or inflation. And the one big beautiful bill was sort of shrugged off by the market and or viewed as a positive by the stock market from a valuation standpoint. I think the bond market's also spoken by having interest rates starting to move up, which talks to the credit worthiness of the deficits that we're building. And, you got to pay higher interest when we're a higher risk country. In the veterinary market, as I said over and over, invoice growth needs to revert back or start growing. Valuations continue to improve, and lots of people are still buying. And we are, in my view, a resilient market because industry fundamentals are weak, valuations are strong, and we hope it continues. And so I'm going to now, if you have questions, please start populating the Q&A feature, which is it should be on your control panel, or you can put questions into the chat if you can't find the Q&A feature. But two other quick slides. This is a quick piece of advice for all of you who are practice owners who are thinking of selling. We like to say that, like, if you go through a sale process as a DIY or do-it-yourself seller, the scales are stacked against you. Like, the folks who are buying clinics are all pretty sophisticated, smart people. You'll deal with a business development executive who's always a super nice person, personable men and women who build relationships with sellers. Behind the scenes, they've got lawyers, a senior management team, private equity firms trying to figure out how to structure deals, not to screw the sellers, but to give the buyers a good deal. Like, they want a better deal. They don't want to pay top dollar. And if you're selling on your own and you've never done this before, like, you've got way less experience doing this stuff than those buyers. And so good advisors, good brokers help tip or rebalance the scales. We like and think we're the best at it, and we would hope that you'll talk to us if you're thinking of selling. But if you're not, you don't want to use us, use someone. It is just important that you get good advice throughout the process. Like, a sale of your veterinary practice is likely the biggest financial transaction you'll ever have in your lifetime. And then finally, one last thing before we move to the Q&A. Ackerman Group runs once a year a veterinary conference called Insightful.vet. It is the only veterinary conference we know of that is exclusively targeted to practice owners. The conference on November 13th to 15th at the Ritz-Carlton in Las Colinas is our third iteration. We started it in 23. We did it again in 24. We limit the size of the conference. It's about 120 people max. We're about 75 to 80% sold. Would love folks to attend. You can get all this information from the QR code. The conference is about 65-70% about how to run your practice better from people who've actually run practices, not consultants who have never run practices, but we get people who actually run practices to give you really good advice. And then the last 30-35% of the conference is about the market, the sale process, real estate, how to, if you're a real estate owner and building owner, what are your options, etc. We do not have a trade show floor. It's all good CE, and we feed people really well, which has been some of the best feedback we get. Besides the content, people really like the food. So that's the conference. And so now I'm going to leave this last slide up and start with the Q&A. So we do have a few people starting to ask some questions. The first question is from someone up north in Ontario, Canada, who asks, do you have any comments about hospitals in Ontario or Canada in general? So yes, we have comments about it. I would say that we've been very active in Canada. Michael Kemp joined us a little over a year ago. We have probably 10 hospitals under engagements that we're working with. And the overall comment about the Canadian market is that valuations are a little bit lower. Instead of 8 to 14, 15, it's more like 7 to 13 times EBITDA. So there's a little bit of a discount, and it's primarily because there aren't as many active buyers. You know, the Canadian market is about the size of California in terms of population and number of clinics, and there are about 7 active buyers up in Canada. So there's a lot of activity. Pricing is good, but it's slightly lower than the US. Hopefully that helps answer that question. Next question. Do you have any experience or recommendations regarding selling specialty practices? We have lots of experience selling specialty practices, and I have lots of comments. I'll try to keep it relatively concise. So I'm going to break it into 2 parts. ER only or emergency only practices have been a little bit harder to sell lately. Finding ER doctors has not been simple. The specialty ER market, there are still active buyers for it. We see pricing similar to GP, you know, pre-COVID and even during COVID. Specialty ER, big spec ER hospitals traded at a premium to GP. That premium is maybe there slightly, but not much. They've sort of come to a similar place, I would say. And the buyers of specialty have changed dramatically. A lot of the buyers from the late 2010s, early 2020s are no longer buying. And there's a new group of buyers that are buying. So understanding who's buying and not buying is pretty critical, because the names you may be familiar with are probably not doing it anymore. And then we've also been selling some single specialty, so single specialty surgery, single specialty dental, single specialty ophthalmology, and that pricing tends to be a little bit of a discount to the GP, even though they tend to be very profitable. And it's primarily because there's just such key person risk in those single specialty practices where, like, you may have 3 or 4 surgeons that generate, you know, $10+ million. Like, you lose one surgeon, there's a lot of profit that goes away with it. So the key person risk on the single specialty practices keeps the valuations a little bit lower, but they're still strong, don't get me wrong. I'm just trying to give comparisons to the GP market. So the next question here is, how are brokers like Ackerman compensated for their advice and service? I can't speak to other brokers, but I'll give a quick discussion of our fee structure. A couple of things. One, we take complete risk with our clients. We don't take a penny of compensation until a deal closes. So while lawyers and accountants get bill out by the hour, we get paid only on success. And so we only get paid when you get paid. The other piece that's very unique about what we do relative to our competitors is Today, 65 or 70% of a transaction value is cash at close, and we will get paid on that cash at close. But on the deferred compensation that you haven't been paid, that's going to be paid out over time, we don't take our compensation at closing. We wait until you get paid. And so if you have an earnout or if you have a joint venture, we help you post-closing make sure you're being treated fairly. And that's very unique in the brokerage industry, both veterinary and other services. And then our fees range from sort of 4% to 7%, depending on the size of the practice. And they are, I think, relative to other groups, their market may be a slight premium to some of the other groups. We think our service is a high premium to everybody else. You won't see this type of data from anyone else. So that's our fee structure. Someone else is asking, will the IDEX Zoetis projection showing increases due to COVID pets aging into higher lab expenses translate into higher practice valuations? So it's a really good question. A lot of the private equity firms are counting on sort of this bubble of veterinary visits, probably starting 2028, 29. Like a lot of COVID pets adopted in 2021 become senior pets, late 27, 28, 29. And yes, I would expect to see more lab revenue and hopefully an increase in visits. My hope is it doesn't take that long, like till 2027 or 8, to see visits start growing again. Hopefully it will happen sooner. But there is a natural shift that over a couple of year period, you will see aging pets translating into higher lab expenses, higher visits or rising invoices. Will it translate into higher valuations? Like, I don't know the answer to that. Like, it just depends on what happens the next 2 years. Because if clinic visits continue to shrink until this bubble happens, like that won't be good for valuations. They may go down and then back up a little bit. So it's really hard to predict. Now, an anonymous attendee asks, what do you recommend for feline individual doctor practices that are doing very well but looking to sell? If you are a one doctor practice, you likely need to talk to brokers that specialize in individual doctor to doctor sales. We, as a firm, specialize in selling to corporate groups, and that's for the larger practices. There are other brokers that will sell and specialize in finding other doctors that'll buy your practice. So if you're a one doctor practice, you're not likely for us, but whoever you are out there, if you want the names of brokerage firms that help individual doctors, we're happy to do it. So email me, text me, or email or text Ryan, and we're happy to help.
Rich, can I actually chime
Please.
in quickly?
Mm-hmm.
So just to be clear, corporate buyers today are not typically purchasing one doctor clinics. However, as a broker for people who are interested in selling to corporate buyers, we provide advice on how to recruit, how to grow a clinic. And so for people interested in growing from one doctor to multiple doctors, we've definitely worked with clients like that in the past. But if they wanted to sell as is, then working with a doctor to doctor specialist broker makes the most sense.
Really good point, Ryan. Thank you. And there's another question on this topic, and I'll expand on it in a minute. But Katie says, can you comment on trends for consumers seeking independently owned clinics? Is the veterinary field following human hospital acquisitions? So those are two very different questions. So the majority of corporations that are buying clinics do not rebrand their clinics. So you will not know if you walk into a Southern Veterinary Partners clinic or to a VetCor clinic that it's necessarily a VetCor clinic. In the human medicine world, everyone's rebranding hospitals and medical practices based on those brands. And they're doing that for, like, if you're a patient and looking for a doctor, you need to know whether your doctor and hospital are part of your insurance network. And you may know, like, for example, I use United Healthcare, and I know that CVS won't work with United Healthcare. I have to go to either Walgreens or some other pharmacy. And so brand matters a lot more in human healthcare. And to be honest, most of the corporations aren't rebranding individual clinics because I think consumers don't want to know whether they're at a corporate, it's not necessarily advantageous for a client or a pet owner to know that they're at a corporately owned clinic. So there's no reason to upset the apple cart and change the brand. There are VCA and Banfield have always created brands, and there's some de novo groups that are opening up lots of new clinics that are building individual brands, but most of the acquirers are not changing brand. So Greta's asking, what is the market like for smaller 1 to 2 doctor practices looking for an independent buyer? So I think the market's fine. The market tends to be 5 to 5.5, 4.5 to 5.5 times EBITDA, and that's capped based on what a bank will lend to a doctor owner. So the lending market and higher interest rates take those purchase prices down a bit. Those were as high as 6 or 6.5 when rates were lower, but with rates higher, the pricings come down a bit. If you are 2 doctors, there might be a corporate buyer if you're in a really good market, the Charlotte, New York City, LA, Dallas, Houston, Atlanta, et cetera, in major growing cities. And if you are a 1 or 2 doctor practice, like Ryan says, and want to see over the next couple of years, can I become a 3 doctor practice that a corporate buyer is interested in? Please call us. We will help you. We have a program that we're rolling out to help people do that, and we'd love to work with folks on that stuff. All right. Next question. What is your take on recruitment of vets? I have a high producing practice with 1 1/4 doctors and struggling to hire a new doctor. Would like to have 1.5 to 2 more doctors and plan to exit in 3 to 5 years. So recruiting is really hard. I would say that our anecdotal data says that recruiting is getting incrementally better. And by incrementally, I mean, when you think about 14 quarters of invoice declines, like the actual total demand for veterinarians is actually down, and the number of veterinarians graduating from vet school is rising year to year as new schools open up and new classes graduate. And so what I would recommend to you who's asking this question is, one, make sure your ads are up and you're recruiting in a thoughtful way. We're happy to help you with that. We've done some webinars and have some stuff in our learning center about how to write ads, how to do things to help with recruiting, and we're happy to have a conversation with you about it. Dennis put something really nice. He says, thank you for your time and informative answers. You're welcome. Shannon says, given that consolidators are gearing more towards larger practices, what is your advice for smaller 1 to 2 doctor practices? My advice to smaller 1 to 2 doctor practices is if you want to exit soon, go to a broker that's going to help you find another doctor. If you want to exit in 5 or 10 years, there's lots of things you can do to go from a 1 to 2 doctor practice to a 3 to 4 doctor practice, and we'd love to help you think those things through. And so it depends, Shannon, on what career stage you're at, what to do. But we're happy to help, and again, feel free to connect with me. We're happy to talk to you about it. And someone else is asking, is there a market for single doctor veterinary practices grossing $7K? I don't know what that means. $7,000, I don't know. But there is a market for single doctor practices. It's a market that is doctor to doctor, not with corporate buyers. All right. I still got I probably have 90% of the people who started on the call still here. So thank you for all of your patience. I'm going to babble for about 30 seconds before I end this to give people some time to ask some final questions. But really appreciate your time. Really appreciate you spending the 50 plus minutes with us. Hopefully it's informative. If you have questions, we're here to help answer them. If you have just questions on data and are not interested in selling, we're here to help answer them and just develop relationships with as many veterinarians as we can help out. Look forward to it, and we will be doing this again in 3 months. And good luck to everyone. Enjoy your summers and have a great night. Thank you.